Jay, you were wrong about the transitory thing, so I just don't know if anyone believes you. Just 1 second, guys. So don't give up too soon on fighting inflation. We got to get this down, all right? Well, we'll talk about this later. So anyway, hey guys, just talking to Jay Powell, and he gave a speech today over the Brookings Institute, and I want to go over some things, and let's get into it. So first, the very first thing is this is a famous quote from John Maynard Keynes. The quote is, "Markets can remain irrational longer than you can remain solvent." So the basic gist of it is, markets be crazy. So it is a fool's errand to think that you can predict everything all the time. In my opinion, right now, I just think markets are nuts because we're still raising interest rates, yet we are rallying today. And sometimes when you flip on the TV or stuff like that, they basically try to explain every single daily move to you. And I would say the better perspective is just take a longer term approach. It's a little bit easier to see what's going on from day to day. Our markets are so volatile. Right now, it is saying, so essentially in the past year, the S&P is down 9.59%, and the NASDAQ is down about 24.82. The crazy thing about this, and that markets are rallying today, is interest rates are still going up. And also, too, we're looking at predictions of a recession next year. So it just seems so strange to me. I'll show you guys more data and sort of what Jay Powell said and sort of why markets may not have been reacting today. But like I said, I try to take a look at a longer term approach just opposed to a day to day. My personal opinion is this is a Bitcoin. I can see the last 5 years it's up 12%. So it's basically flat in the last 5 years. Until Bitcoin and all that crypto stuff bottoms out, we won't have a bottom to the markets. That's my opinion on that. Now, the question is, where is the bottom of Bitcoin? You can type in the chat what you think it is. My personal opinion is I think this stuff's worthless. However, it is a real thing that criminal activities, money laundering, all these kind of things are done through crypto. So I don't think crypto is necessarily going to disappear as long as people are still using it for nefarious reasons. And I also get it. Some people prefer to do this in terms of sending money internationally. There is some use value to that. But overall, though, if I given a choice, I take dollar. I would definitely take dollar over Bitcoin. But yes, markets around the day on words of Federal Jerome Powell. And we'll take a look at what he said. So here's the basic headline. They're saying, okay, guys, we're going to still raise rates, but not as high as before. The rumor on the street's been for a while that they're going to raise it 50 basis points, so 0.5%, which is still a lot. Just imagine your mortgage going up 0.5%. It's not fun, right? So let's read this. Jay Powell sent a strong signal that the Federal Reserve will slow the pace of interest rate raises next month, and otherwise hawkish speech warning the central bank has a long way to go in its fight against inflation. So this, if you listen to, if you just understand this language, it's funny. The speech itself was hawkish, but he's like, hey, we're going to slow down interest rates. And the market's like, okay, great. And they start rallying, but we're still raising them, just not as fast as before. Because we've been raising, 75, 75, 75, and now we're raising it 50 basis points again. That's 0.5% if you don't know. And it's just markets are kind of just be crazy. They're irrational. Here's what else I said. There's a quote from Jerome Powell. My colleagues and I do not want to over tighten, right? So we're talking about economic policy and trying to essentially, raise rates so much to slow down the economy too much or cause too big a recession. That's what they're saying here. And then we'll read more. Powell balanced his comments about the forthcoming rate decision with a full-throated pledge that the Fed would not relinquish its fight against inflation until price pressures had slowed to a level more in line with its long-standing 2% target. So, it's crazy. Again, I just want to reiterate. So remember, their plan is to get inflation down to 2%. They are raising interest rates, right? Raising interest rates slows the economy. Raising interest rates is most likely going to cause unemployment. Raising interest rates basically makes the cost of money more. And so this idea that the markets are rallying is so weird to me. And it is what it is. Let's keep looking here. But again, that's why I say look at the long-term chart, not just the daily thing. Here's more quotes from Jay. I will simply say that we have more ground to cover, and quote, history cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So they're literally telling you, hey guys, we're going to raise interest rates, maybe not as fast as before, but we're still raising them, and we're going to keep it elevated until inflation comes down. Now, if you want to take a bull case scenario and say, well, the market is betting that inflation is going to come down and we're going to go on another bull run again, but it doesn't really make sense to me because we're not printing money again like we did before. We're in an era of quantitative tightening, not quantitative easing. I made a video on that. You can watch that. Please find it. I'll put a link here. But, let's just keep going through this stuff. And so that's why I'm laughing about this, why are markets rallying? What's going on? Okay, let's go more. His wide-ranging speech about the outlook for monetary policy, Powell cited several factors that could exert downward pressure on inflation. Remember, the whole goal is to get inflation down to 2%. including further declines in goods prices, right? So stuff costing less could help. Also in regards to related to the housing sector, right? But he also warned that while inflation forecasts from the Fed and others pointed to a, quote, significant decline over the next year, the central bank has repeatedly wrong-footed by incorrect projections in the past. So it's funny because he's like saying, okay, it looks like, inflation will come down next year, but we've been wrong a lot before, and maybe we'll be wrong again in the future. So the point is, it's tough to predict the future, and I'll give him a pass on that one. But like I said, I think the markets is just really funny that we're rallying so much because the markets are rallying a lot. I mean, I've seen it. It was like the last couple of months we've been going up, and it's just so weird to me. But this is the stock market. Things can do whatever they want to do, but ultimately, over time, things will trade at their fair value, and we keep getting there. Slowly but surely. Let's just see some more quotes here. The truth is that the path ahead for inflation remains highly uncertain. And and he said, adding the Fed has not yet seen, quote, clear progress of slower inflation, right? He's literally saying in his speech that, it's uncertain and we haven't even seen, evidence that it is clear progress that we're slowing inflation. Here's more. Powell cautioned against reading too much into the October CPI, right? That was one of the inflation reads in October. A report instead stressed that it would take, quote, substantially more evidence to give comfort that inflation is actually declining, meaning that that's just 1 month of data. It went down, yes, but let's give it a few more months to see if that is really the case, right? Do you see what I'm saying? So markets are funny, guys. In order to bring inflation back down, Powell warned that the labor market must be substantially softer and there would be a need to sustained period below trend growth. So basically, like literally, he's saying it. You need to lose your job, basically is what he's saying. And it's got to be a sustained period of below trend growth. Like we're growing too much. We got to slow these things down. And I know it's frustrating out there for people to hear these things, especially like if you're struggling at the moment, knowing also too that more jobs are going to come. But that's essentially the trade-off is like, do we want a whole bunch of high prices, slash inflation everywhere where everyone has a job, but like prices keep spiraling, or do we want to sort of like get that under control? And that's sort of the goal of the Fed is have stable prices, right? It's what they're trying to do. Is a stable economy and stable prices. Unfortunately, people are gonna have to lose their jobs, and it's an unfortunate thing. Like I said, I think unemployment's at 3.7. Projections are going to go to 5, and it could go as high as 10, but we'll see. What else do they say here? While Powell signaled that the slower pace of rate rises was forthcoming, right? He emphasized that, quote, timing of that moderation is far less significant, meaning that, don't worry about how much you raise it from, month to month, but like think about like the long-term trend. This is sort of like the same thing I'm sharing with you, the same sort of talk he's saying as well, right? How much further we will need to raise rates to control inflation and the length of time will be necessary to hold policy at a restrictive level, right? So we're talking about, think about, don't just worry about like when we're going to do it. Like for example, they could raise, say, 0.25%. They could do that for like 3 years, like for example, right? They could do it every month for 3 years, for example. Or are they going to just do like a full percentage point every month, right? This sort of thing. But the more important thing is like think about the long-term trend, not necessarily how much they're going to do each month. And one of the things that the reason why you would slow down interest rates in December is just like it takes a while for interest rate changes to gauge in the economy, gauge in the housing markets, right? So, for example, today, if I say everybody, we're going to raise interest rates by 0.5%, it takes a while to that reflect in home sales, because the consumers start to think, okay, am I buying, am I selling, what am I doing, this kind of stuff, and it takes a while for them to reiterate, right? So this is sort of what's going on, and it's like a market needs to catch its breath a little bit from all of these crazy rates we've been raising really quickly. Let's keep going here. He reiterated that the endpoint of the tightening cycle would probably need to be higher than forecasted in projections released in September. So like he's even saying like the longer term amount that we're going to be raising is higher than what they thought before, which suggests that most officials anticipate a so-called turn rate of 4.6. Most economists have penciled in Fed funds rate topping 5. So the way this goes is the Fed and Jerome Powell, generally speaking, they try to give you the rosiest situation possible, right? And then other people will like, okay, what could it really be? So they've been saying, the top rate will be 4.6, and economists are saying like 5. That's what everyone's been reading. And it was the same thing with unemployment. They were saying, oh, maybe it'll be 4.2. Okay, maybe it'll be 4.3. And I've been saying, guys, it'll probably be higher. And it's the same. So do take this with a grain of salt, but you do want to understand, though, this is also very true. Jay doesn't necessarily just make stuff up. So when he says they're probably going to be, slowing down in December. That's probably what they're going to do. Okay, let's see what else he says here. Jay says, it can't be that we go on for 5 years at a very high level of inflation and that it just doesn't work its way into the wage and price setting process pretty quickly. That's a serious concern, right? So you don't want inflation to be around, all this time. And the other thing is too, is like, it becomes embedded, especially with people's salaries. Once a company starts paying, say, for example, let's say McDonald's decides to pay everyone $25 an hour. What do you think that's going to happen to prices at McDonald's, right? And it just reverberates throughout the economy. So obviously then no longer the dollar menu, as someone wrote in the comments yesterday, no more dollar menu at McDonald's because you got to pay workers more. And then when the cost of McDonald's go more, everyone else wants to get paid more to pay, I'm sure you guys get it. It's a domino kind of thing. Now remember too, the Fed wants the essentially inflation rate to go down to 2%. But it actually depends on how you measure it. There are two ways to measure. There are CPI and the PCE. The Fed prefers the PCE. I'm going to read a little bit so you can understand a little bit the difference. We can see some details here because they are different measures, but it measures the same thing, just slightly different, like you say, variables inside of it. So here's the differences. Conceptually, there are two gauges that measure two different things. Now remember, there's CPI and PCE. The Fed uses the PCE. The CPI aims to capture out-of-pocket spending by Americans, this is how we measure inflation, leading to notable weighings for things like rent and cars. What are the cost of stuff, right? Like renting cars. But the PCE tries to measure the cost of everything we consume, whether households directly foot the bill or not. The result is a big difference in the weighings of categories in which costs are included in the measure. So you can see there are different things in each one. And if you actually ever go to the website and look at the things, it's like really funny, all the different stuff in there. Like sometimes you'll see like it's like men's sweaters and the cost of eggs, and then you'll have like school books and tuition. All kinds of stuff is in it, and it's slightly measured differently. And so what I was saying is like one is more like stuff that you pay out of pocket, and the other one is sort of like stuff that we all pay together. But some stuff might be paid for by, say, Medicare or your employer. So like, for example, it says here, this is most notable in regard to healthcare. Unlike the CPI, the PCE includes all healthcare spending included by employers on behalf of workers, as well as tax payer funded programs like Medicare, right? So if you want to track the cost of things, this is sort of why the Federal Reserve would use the PCE, because like, for example, something covered by Medicare, it still costs somebody money, right? So you're also tracking that. And, for many workers or many people, they have health insurance through their employer, right? And these kind of things. So this is sort of why they use two different indicators. One of the things that is important, though, when you look at both of them, is that you just want to get a larger picture of sort of what things cost, right? And take a look at this. Like, for example, this is a larger picture of just like, how much does our shelter cost? Because you can see here, essentially, homes and rents keep going up. And then salaries need to essentially rise with that. Now, one thing that's been happening for many people is salaries aren't rising fast enough to keep up with housing and food costs. And so essentially our real wages have been going down. I think you guys know this stuff already who are watching the channel and stuff like that. And from your regular life. And if you take a look at the comparison, so sometimes like when you see different numbers, the PCE or the CPI, there's a big difference in, say, healthcare. You can see this here. So the black boxes here is the PCE, and then the blue box is the CPI. So for healthcare, the CPI is way more volatile for those measures. And the difference between the two, actually, I have a chart right here. So according to this one, and this would show that the PCE in this chart here is around like 4.5-ish, 5-ish%, something like that, where the CPI is around 6-ish, right? The Fed wants essentially inflation to be at 2, so we're still high compared to where it is now. And it depends which measure that you look at. Now, the Fed prefers the PCE, but I'm saying we're looking at both of these things together. And so this is why when you take a look at this chart, like here, this is from the Fed. This is the stuff that they look at. You're looking at the total PCE and the core PCE, right? So again, this is the measure that the Fed is looking at to say, okay, where's inflation? We wanted it 2. It's closer to like a 5-ish. Total PCE is 6. The difference is between the blue line and the red line here, as the core is without food and energy, and then the blue line includes food and energy. And the reason why sometimes you strip out food and energy because it's just too volatile and it moves up and down all the time, especially like, say, energy with like, crazy moves and the winter costs and stuff like that. But still, you can see that we're still pretty high. So you could say we're PC is like, around 5 to 6% basically, and they want inflation to be at 2. So we got a long ways to go. And so sort of, what we're talking about here is the Fed is raising interest rates, as you guys know, and they're going to keep them elevated for some time. And so it's like, okay, so why is the market rallying? I mean, we're still raising rates. So, I'm laughing about it, but this is the stock market. And, I can't predict the future 100. And this is sort of why you essentially hedge your bets, right? You say, okay, fine, I don't know what it's going to do exactly. I'll put some money in stocks. I'll put some money in real estate. I'll put some money in cash. I'll put some money in bonds, these kind of things. You do different things. And you essentially allocate according to what your risk profile is, essentially. You can take a look at this. This is really interesting as well. This shows also, this is coming from the Fed, the numbers that they're looking at. So this is the cost of goods. You got houses in there, this kind of thing. And it looks like housing services, which is something that they're mentioning here, is going up quite a bit. So I'd love to hear your guys' thoughts on this, where you live, if those kind of things are going up or down. I just did a video recently, just right before this, and we were looking at the housing market, some projections where it could be a bull market case, it could be a market crashes 10%, or crash, whatever you want to say, it goes down 10%, and then a worst case scenario is more like 25, 30% that the housing market could come down. My personal opinion is interest rates are going up, so I think that's obviously going to slow the purchasing of a home, and the housing market will decline. So anyway, that's everything going on. That's what Federal J. Powell said. Love to hear your guys' thoughts on these things, and what you think about the markets and where you think we're going to go from here. So I've shared my opinion. Love to hear your opinion as well. Thanks again for watching, and I'll catch you guys in the next video.